All right, so financials and utilities leading the way today as once again a major bank posts major numbers on the beat. We're talking Morgan Stanley for the third quarter. So they brought in $1.88, $1.88 in earnings. Street was looking for $1.60. Revenue $15.4 billion versus $14.36. Equity sales and trading was over $3 billion. The Street was looking for $2.7. Wealth management $7.3 billion. Street was looking for $6.8. Sales and trading revenue $2 billion. Street was looking for $1.8. I can go on and on and on. In fact, if you take a look at this chart, the company's performance really only second to Goldman Sachs. I want to bring in Kobeissi, editor-in-chief, Adam Kobeissi. And Adam, so 8 sectors up, 3 down. The so-called rotation trade certainly making up for weakness in technology, and it's working. Your thoughts?
Yeah, I mean, it's interesting because we had tech leading the whole run higher all year, and the narrative was that the minute tech starts to collapse, the whole market's going to collapse. Well, now you're starting to see the market rally actually broaden out, which is a bullish sign. And I think what it really has allowed to happen is a lot of these large cap tech stocks, all the AI trade, which by the way is still alive, but a lot of those stocks have had time to consolidate from a technical perspective. And we actually, I mean, if you look at NVIDIA, for example, NVIDIA fell almost 40 to 50% from its high. It fell from 140 down to 90 at one point. Now back to 135, looking for new all-time highs. So I think a lot of these tech stocks have actually almost already gone through a quiet bear market over the last few months here, and now kind of setting the road for 6,000 in the S&P 500.
So, I mean, obviously you're still bullish on the market. You're looking, is that your new target, 6,000?
Yeah, so I know I've been raising it every single time I come on the show this year, and now we're starting to say, 6,000, and I think we can see that by year end. And one of the biggest fallacies too is that election years are bad for the stock market. We did all the research and looked at all the data. The election year is actually great for the stock market. On average, the S&P 500 returns 11% during a stock market or during an election year, and almost 80% of all election years dating back to the 1920s have had positive S&P 500 returns. So I don't think the election is the reason to get bearish here, and clearly the data says the same thing.
One thing we know in election years, the government's pumping even more money than usual, trying to buy votes indirectly. And, no matter how you feel about that, we know it always goes to the bottom line of corporate America. Let me ask you about the Fed, because 2 weeks ago, the narrative was, hey, buy this market because we're going to get a 50 basis point cut. Now the narrative is switching a little bit. Hey, buy this market because it doesn't need any rate cuts. Are we just in a win-win situation when it comes to the Fed right now?
Yeah, and that was something that going into the last Fed meeting, we published a note for our subscribers and said, and we even put this on Twitter, we said everyone was so worried about 25 versus 50. We said we don't even care what's going to happen. We know that after this Fed meeting, stocks are going to go up because it's going to be viewed as a de-risking event and the Fed's going to quote unquote pivot. Now the pivots pull it back, but the equities are still going up, gold's still going up, bonds are starting to recover again now after dropping a little bit. So I think we can actually see a market where we don't get some super aggressive Fed policy and with rate cuts, maybe 25 bips at a time, maybe even skipping one of the meetings before year end, but still have higher prices in equities in the S&P 500.
I saw where you were bullish on bonds. I just got 30 seconds, but I'm a little bit surprised that you're bullish on bonds right here.
So this has been more of a near-term trade, and I think it's because we saw the 10-year move from 3.6 to 4.1%. After the Fed 50 basis point rate cut. I feel like now we're actually starting to see, the hawkish argument, and I'm not going to call it hawkish with, as in rate cuts, but maybe overpriced, and I think that's a bullish catalyst for bonds and gold. So we're bullish to both.
Hey, Adam, I love these segments when you come on and you're grappling with whether or not to raise your target. That means we're heading in the right direction, my friend. Thank you very much. All right.